Well, hello everybody. This is Bill Poulos. I want to wish you a good morning, good afternoon, good evening, wherever you may be. And I want to welcome all of you to the call tonight. I think you'll find it very informative and interesting, whether you're a beginning trader, have never traded, or have been in the game for some time. We're going to talk about the key messages from my book on the profit button, and I'm going to also introduce you to our trading course, Instant Profits, and then we're going to spend time with question and answer, because I want to make sure you get these key points that we're going to cover tonight well understood. What I'm leading off with here is what you don't know can wipe out your portfolio. And whether you're a buy and hold investor in mutual funds, or whether you're a trader, or whether you have your money in relatively risk-free, low-interest investment vehicles, having lack of knowledge around those different strategies can really hurt you. And I want to talk about some of those key strategies tonight so that you don't fall into any of those common traps that a lot of people do. So let's get right into it. I've stirred up a good deal of controversy talking about the death of buy and hold. Buy and hold is when you're always invested in the market. You don't try to time the market. You're always in 100% in some fashion in stock equities, whether by buying stocks directly or through mutual funds or other funds. You're always 100% invested in the market. And this has been a time-honored strategy, and it's based on the idea that the market always goes up in the long run. And that in the U.S., for example, the S&P 500 has averaged somewhere in the area of 8-9% a year gain over several years, over 50 years or more. The problem is not every year does the market go up, and in some years it goes down dramatically. So I'm going to point out to you why I think buy and hold really never was a good strategy, and today in particular is a potentially very dangerous strategy. So then, what does that lead to then as the alternative? Well, the alternative would be some form of trading in and out of the market. And my preference is swing trading, where you enter the market under the best conditions you can define. You stay with the trade for the end of day traders. You stay with the trade for a week to maybe 5-6 weeks. You exit according to your profit exit strategy, and you go on to the next opportunity. For shorter term traders, for day traders, they're trying to get in and out of a trade in a matter of 3 to maybe 20 bars, whatever time frame they're trading. So if you're not a buy and hold investor, you're going to get into some sort of trading. And that has a lot of risk associated with it as well. It's certainly not risk-free. Anytime you're trying to grow your portfolio, it's about managing risk, whether you're buy and hold or whether you're trading in and out of the market. And so if you're a trader, you've got to be able to manage risk very carefully, and you've got to have a good trading method, and you've got to have a few other things that we're going to talk about tonight. Since the late 1990s, the buy and hold crowd is financially shipwrecked. What does that mean? What I'm talking about are those folks that bought into the dot-com craze in the late 1990s, or even bought relatively conservative Dow Jones stocks in that same period. And I'm going to show you some charts that might surprise you. because those that bought those stocks back then and still hold them have indeed experienced what amounts to a shipwreck. Now, this strategy requires that you never sell, or you're always in the market. You might sell stock A to buy stock B, but you never go to cash. Or you might sell mutual fund A to buy mutual fund B. And the goal is to replicate the index performance. In the U.S. it would be the S&P 500, for example. And that strategy says, well, if the S&P 500 goes up 10% in a year, then I would expect my buy and hold strategy to go up at least 10%. But the reality is it's very difficult to replicate the index performance, and what happens most of the time is folks will might go up 8% or 7% when the S&P is up 10. Now if the S&P goes down 10, then the goal would be to only go down 10 with the buy and hold strategy. But the reality is usually goes down more. 12%, 13%. Again, it's very difficult to replicate the index performance. But even if you could, I'm going to show you some charts that suggest that just replicating the index may not be the best thing for you. Now it all boils down to risk. And this is how I define risk. There's two components. One is the percent drawdown, and this is an equity curve. Here's the dollar value of your equity going up over time. So it goes up, makes a peak, and then drops. That's called a drawdown. And then it goes on up, hopefully, to make a new high. You suffer through that drawdown, and then you go on to make new highs. Now, what are the two components? Well, first is the percent drawdown. From this peak right here to this valley, you've got a drop in equity. That's the percent drawdown. And then the time to break even is from this peak to when the equity curve goes back on up above that previous peak. However long that takes, that's the time to break even. Now, when you put the two together, you have a very good definition and metric around risk. Okay, so time to break even and percent drawdown. Now I'll put that into a real world situation. The Dow Jones Industrial Average in 1929 reached a peak before the 29 crash, and it dropped, as you all know, and it continued on down through the Depression, and it did not reach the 29 peak again until 1954. So there was 25 years was the time to break even. 25 years. And the percent drawdown was horrific. It was more than 90%. Now, that is significant risk. So if you were a buy and hold strategist, investor back in 1929, of course, it'd take you 25 years just to get back to where you started. And that's if you never sold anything. That's if you had the nerve to hang on through that entire period.